Right now, the US stock market is being driven by two main engines: artificial intelligence and consumer spending. But there's one problem: they're not running at the same speed. Ultimately, this disconnect could become a problem for the stock market. Here's what you need to know about this dynamic. Overall, the AI engine is running at full throttle. The investment cycle is accelerating, and we're seeing demand broaden across the entire supply chain. Companies tied to AI infrastructure are seeing strong revenue growth, and capital expenditure budgets among some of the largest US cloud providers are on pace to exceed $750 billion this year. In our view, massive AI investment and growing demand for semiconductor chips, data centers, networking gear, and power are the main reasons the stock market is continuing to hit record highs. However, AI can only bring the market so far. At the end of the day, the consumer is the backbone of the US economy, and their spending translates into earnings across multiple industries. Here, the story is a bit more complicated. Jobs are still being added in areas such as trade and transportation, and healthcare and social assistance. But higher paying sectors like tech and finance are slowing, and wages overall are not keeping pace with inflation. At the same time, costs remain elevated for Americans. Gas prices are high, savings are shrinking, and real purchasing power is under pressure. And lower income households in particular, who haven't benefited as much from rising stock prices, are feeling the brunt of elevated costs. Overall, this situation has translated into consumer sentiment that sits at some of its lowest levels on record. Bottom line, the AI engine is running at full throttle, while the consumer engine is showing signs of slowing. In our view, this imbalance is not a sustainable, healthy condition for future stock gains. For this market rally to continue, we believe both engines need to be running well. Overall, investors will want to be aware of these growing risks and be prepared for the possibility of volatility, particularly if AI momentum loses steam or Middle East developments drive energy costs higher. Regardless, we believe the environment still supports staying invested and maintaining a well-diversified portfolio, given our expectations for strong profit growth this year and secular drivers across AI, which, despite potential bumps, should continue to provide fundamental support for stocks. If you have questions about how the current market backdrop could affect your personal portfolio, reach out to your Ameriprise financial advisor. Thank you.